Good evening, investors. Welcome back with me, Madhaveshwari, on KleverStock, serving you the latest updates for the closing bell this evening. Kicking it off with evening updates from Bursa Malaysia. Bursa Malaysia's benchmark index remained higher at mid-afternoon today, primarily led by financial services counters as index-linked banking stocks successfully recouped losses from the previous session. As of 3 p.m., the FBMK LCI climbed 12.94 points or 0.76% to reach 1,713.15 from Monday's close of 1,700.21. The recovery was anchored by several heavyweights in the financial sector. Maybank surged 14 cent to 11 ringgit 86 cent, while CIMB rose 6 cent to 8 ringgit 2 cent, and Public Bank gained 2 cent to 4 ringgit 87 cent. This collective movement pushed the financial services index up to 172.67 points to 21,001.77 points. Analysts noted that the resilience of the KLCI was largely supported by its heavy weighting in these financial stocks, which helped cushion the index against broader market volatility. Despite the gain in the composite index, the broader market breadth remained slightly negative, with losers outnumbering gainers 567 to 503. A total of 497 counters were unchanged, while 1,057 remained untraded. Total turnover stood at 2.18 billion units, value at 2.09 billion ringgit. On the most active list, Bumi Armada put on 2 cent to 37 cent and Tanco garnered 3 cent to 1 ringgit 64 cent. Across the broader indices, the FBMT 100 index gained 76.64 points to 12,381.35, and the FBM Amas index added 73.89 points to 12,554.88. Sector-wise, performance was mixed, while the energy index rose 12.57 points to 790.74. The plantation index dipped 17.76 points to 8,178.80 points. The rebound comes as investors engage in bargain hunting activities following Monday's sharp losses triggered by escalating geopolitical tensions in the Middle East. Now, for some local economic news updates. Prime Rating Services Berhad has reaffirmed its growth forecast for Malaysia's economy, projecting a gross domestic product expansion of 4.0% to 5.0% for 2026. The rating agency cited the continued strength of the domestic economy as core anchor, even as a sea of red geopolitical and trade headwinds gather on the horizon. A significant portion of the cautious outlook stems from shifting trade policies in Washington. While the U.S. Supreme Court recently struck down previous reciprocal tariff measures under the International Emergency Economic Powers Act, RAM Ratings noted this provided only temporary relief. The U.S. government almost immediately followed up with a new 10% global blanket tariff under an alternative law, with a further increase to 15% for some countries currently under consideration. While these scenarios are less punitive than original proposals, the agency warned that uncertainty remains elevated, particularly regarding potential new tariffs targeting semiconductors, which could impede Malaysia's growth momentum. The rating agency also flagged the escalation of military conflict in Middle East as a critical risk factor. The military strikes conducted by the US and Israel against Iran, followed by retaliatory attacks on US bases, have injected significant uncertainty into global oil markets. RAM Ratings highlighted that the Strait of Hormuz, a narrow maritime choke point bordering Iran, handles close to 30% of global seaborne oil trade. For Malaysia, the most immediate direct impact would likely stem from higher oil prices and potential supply disruptions, given that approximately 30% of country's mineral fuel imports originate from the Middle East. Despite this risk, RAM Ratings pointed out that broader trade disruptions are expected to be relatively limited, as the Middle East is not a major trading partner for Malaysia. The agency noted that Malaysia's exports to and imports from the region account for only 1.9% and 4.7% of total trade, respectively. The primary concern remains the indirect channels of global trade volatility and the potential for elevated oil prices to persist as long as the conflict continues, which could influence domestic inflation and cost structures. Still on national news, Malaysia's economy enters 2026 on a resilient footing, characterized by a steady growth outlook fueled by a global tech upcycle and a surge in high-value investments. This assessment was shared at the City Malaysia 2026 Macroeconomic Forum, which convinced the senior corporate leaders and market participants to discuss the nation's financial trajectory. According to City Research, the positive momentum is being supported by firm electrical and electronics and semiconductor exports, a tightening labor market, rising foreign direct investment, and a sustained recovery in the tourism sector. Vikram Singh, City Malaysia's country officer and banking head, noted that the country remains well positioned for long-term growth due to a stable macroeconomic environment backed by a clearer and forward-looking policy agenda. They emphasized that the current period of stability provides a unique opportunity for businesses and policymakers to prepare for future challenges. Vikram stated that there is a saying that the time to fix the roof is while the sun is shining. Today's forum is a reminder that Malaysia continues to be a good place to do business with a stable macroeconomic environment supported by a clear, coherent and forward-looking policy agenda. The forum, which featured Deputy Finance Minister Dato' Liew Cheng Tong as a guest of honor, highlighted that the country's fundamentals remain sturdy despite shifting global dynamics. Vikram also added that now is a compelling time for businesses and policymakers to build capacity, strengthen resilience, and position Malaysia for strong-term competitiveness. By leveraging the current period of economic sunshine, the group believes Malaysia can solidify its status as a preferred regional hub for sophisticated manufacturing and digital infrastructure. Up next, we have some updates from the Middle East. Global oil and gas shipping rates have vaulted to unprecedented levels as the military conflict between the United States, Israel and Iran effectively paralyzed the Strait of Hormuz. Following the weekend's assassination of Iranian Supreme Leader Ayatollah Khamenei, Tehran's retaliatory strikes on regional vessels and in energy facilities have pushed supertanker costs to all-time highs, with industry experts warning of a weak vessel supply for the remainder of the month. Shipping through the waterway, which handles 20% of global oil and large volumes of liquefied natural gas, slowed to a near stop after vessels were targeted in the crossfire. According to LSEG data, the benchmark freight rate of very large crude carries on the Middle East to China route doubled over the weekend to a record world scale 419, or roughly $423,736 per day. One oil ship broker noted that it is very difficult to assess shipping rates in the Gulf as several ship owners have suspended operations indefinitely. The crisis deepened on Monday after Qatar Energy suspended production at its Ras Laffan plant, the world's largest LNG export facility, following report drone strikes. This unprecedented move sent European gas benchmark futures soaring by 45% to 50%, marking the biggest energy shock to the continent since the invasion of Ukraine. LNG shipping rates followed suit. Atlantic spot rates rose 43% to $61,500 per day, while Pacific rates climbed 45% to $41,000 per day. With the strait technically open but functionally ceased for commercial tankers, major shipping nations are issuing emergency directives. South Korea's maritime ministry has officially urged its shippers to refrain from the business operations in the region and is holding emergency meetings to secure alternative oil supplies from outside the Middle East. Similarly, the world's largest container line, Maersk, has implemented an emergency freight increase for all bookings to and off from Arabian Gulf to cover the soaring operational cost and insurance premiums. Fraser Carson, principal analyst at Wood Mackenzie, warned that daily LNG shipping rates could surpass $100,000 this week. Carson stated that until safe passage through the Strait of Hormuz can be assured, shipping will remain idle. As insurance providers begin withdrawing war risk cover for the Persian Gulf, the global energy ecosystem remains in a state of high-stakes suspension, waiting for a diplomatic and military breakthrough. And finally, wrapping it up with corporate updates. Malaysian energy giant Petronas has confirmed that its operations remain undisrupted following the recent military escalation in the Middle East. In an official statement issued on Tuesday, the company clarified that it has seen no direct impact on its regional activities, despite the intensifying conflict between the United States, Israel, and Iran. Petronas stated that at time of writing, there were no reports of any direct threats to Petronas personnel or assets, and operations continues as usual. The firm's response comes as Iran's retaliatory missile strikes have begun to affect the United Arab Emirates, triggering defense interceptions and disruptions at the major transit hubs. Petronas has significantly expanded its footprint in the UAE in recent years, securing several high-profile oil and gas exploration concessions in Abu Dhabi. These include a 100% quality stake and operation ship of the massive onshore Block 2 and conventional onshore Block 1. While these assets are located within the Al Dhafra region, an area that has seen increased regional security alerts, Petronas emphasized that business continuity measures are firmly in place. The company stated that it will prioritize the well-being of those supporting its operations in the region while taking steps to safeguard its assets. These includes active coordination with local authorities to assess the evolving security landscape and the implementation of precautionary protocols for its workforce. The broader energy sector remains on high alert as Iran's Revolutionary Guards have threatened to close the Strait of Hormuz, a critical artery for global oil flows. While Petronas maintains that its personnel are safe, other regional players have taken more drastic measures. Thai producer PTTEP has reportedly evacuated non-essential staff from high-risk zones in the Gulf. For now, Petronas is maintaining its dual focus of sustaining domestic production while protecting its international portfolio. The company's activity outlook 2026 to 2028 recently highlighted a geopolitical upheaval as a persistent challenge, urging its partners to focus on supply chain resilience and operational excellence. Petronas concluded that it remains committed to balancing domestic obligations while seizing international opportunities safely and reliably despite the current crisis. Well, that's a wrap for Closing Bell Updates with me, Madhaveshwari. Thank you, investors. We shall catch up in the next session. Goodbye and see you soon.